Would you like to own a stake in over 6,000 rental properties? Would you like to collect a monthly rent check without being a landlord or doing any of the hard work? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
I want to tell you about a high-quality dividend growth stock that pays you big, growing monthly dividends. These monthly dividends are like rent checks because the business owns over 6,000 properties and rents them out to hundreds of tenants across 50 different industries. I've personally invested in stocks like this one on my way to going from below broke at age 27 to financially independent at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Well, buying a dividend growth stock when it's undervalued should provide a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Realty Income, which appear to be trading at a significant discount today. Realty Income Corp, stock ticker O, is a real estate investment trust that leases freestanding, single-tenant, triple-net leased retail properties. Founded in 1969, Realty Income has grown into one of the world's largest retail REITs. Their portfolio of over 6,400 properties is spread out across 49 U.S. states, Puerto Rico, and the United Kingdom. They have over 300 tenants across 50 different industries. Realty Income ended fiscal year 2019 with a 98.6% portfolio occupancy. The remaining weighted average lease term was 9.2 years at the end of fiscal year 2019. Through incredible geographic, tenant, and industry scale and diversification, they've built a durable business model that's positioned well to survive the current circumstances and thrive once we return to normal. That's because most of their tenants provide the products and/or services that allow us to live our everyday lives. These industries, while subdued now, aren't going anywhere. Think pharmacies, gyms, convenience stores, gas stations, and grocery stores. Best of all, buying shares in Realty Income allows you to be a landlord without doing any of the heavy lifting yourself. No scouting properties, applying for loans, screening tenants, or dealing with repairs. Plus, you immediately get exposure to a large cross-section of the American economy, much better than just one local property in your area, which is very risky. And they use triple net leases, which means the tenant is responsible for net building insurance, net common area maintenance, and net real estate taxes on the leased asset. That insulates Realty Income from a lot of responsibilities, but they're still able to collect those rising rent checks from tenants. These rising rent checks get filtered down to the shareholders, which is where the rising monthly dividends come in. In fact, Realty Income has branded itself as the monthly dividend company, and for good reason. They've paid 598 consecutive monthly dividends, and they've increased their dividend for 27 consecutive years, which is every year since they've gone public. The 10-year dividend growth rate is 4.7%. That dividend growth rate is actually pretty high when you layer that on top of the stock's yield of 5.06%. This yield, by the way, is more than twice as high as what the broader market offers. It's also more than 80 basis points higher than the stock's 5-year average yield. Their dividend is protected by a payout ratio of 85%. That's against funds from operations per share. While that looks high, a REIT is legally obligated to pay out at least 90% of their net income in the form of a dividend. Thus, REITs ordinarily operate with elevated payout ratios as a consequence of the business model. Looking at business growth, Realty Income grew its revenue from $345 million in fiscal year 2010 to $1.492 billion in fiscal year 2019. That's a compound annual growth rate of 17.67%. Truly exceptional. The company has grown revenue at a blistering rate. However, we have to keep in mind that a REIT often issues equity to fund growth because of the aforementioned legal structure that prioritizes dividends. Indeed, Realty Income almost tripled its outstanding share count over the last decade. Looking at growth on a per-share basis provides a more accurate view. And when looking at per-share growth for a REIT, you want to look at funds from operations instead of normal earnings. This is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back to earnings. The company increased its funds from operations per share from $1.83 to $3.29 over this period, which is a compound annual growth rate of 6.73%. Still very strong, but we can now see what the more realistic growth that representation is. Looking forward, CFRA, a professional equity analysis service, is forecasting a 5% compound annual growth rate for Realty Income's funds from operations per share over the next 3 years. Moving over to the balance sheet, Realty Income maintains a rock-solid financial position. They have $8.8 billion in liabilities against $18.6 billion in assets. Their credit ratings are well into investment-grade territory, A3 from Moody's and an A- from S&P Global. Moreover, many of their top tenants are investment-grade businesses in their own right. That includes the likes of Walmart, Home Depot, and FedEx Corporation. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Real estate is highly cyclical. Tenant health and demand for real estate are dependent on the broader economy. As a REIT, due to the capital structure, they must consistently rely on external funding. This can compound problems in recessions, since the return on equity issuance is often much lower. While broadly diversified, some of Realty Income's tenants are facing headwinds as they relate to changes in retail. Lastly, there's a dearth of durable competitive advantages in real estate, but the stock has been and looks set to remain a great long-term investment. Better yet, the stock looks undervalued after the recent massive correction. The price to funds from operations ratio is 16.8. This is a stock that usually commands a P to FFO ratio of around 20. The price to cash flow ratio is 16.3, which is well off of its 3-year average of 19.1. And the stock's yield, as I mentioned earlier, is significantly higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate and a long-term dividend growth rate of 3.5%. This dividend growth rate appears conservative when comparing it to what Realty Income has done over the last decade. Both dividend growth and funds from operations per share growth are measurably higher. However, I think both near-term and long-term concerns remain about retail in general, as well as Realty Income size. I would expect dividend growth to slow a bit, but that's compensated for by the high starting yield. The dividend discount model analysis gives me a fair value of $64.40. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. We can compare that to where professional equity analysts are at with this stock. Morningstar rates Realty Income as a 4-star stock with a fair value estimate of $65. CFRA rates Realty Income as a 4-star buy with a 12-month target price of $86. My valuation was within pennies of where Morningstar is at. Averaging the 3 numbers out gives us a final valuation of $71.80. which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. Realty Income Corp is a high-quality REIT that's built an incredibly diversified portfolio of real estate. Buying the stock gives you instantaneous exposure to thousands of properties, allowing you to collect a monthly rent check without doing any work. With a market-smashing 5% yield, more than 25 consecutive years of dividend raises, a proven commitment to the dividend, and the potential that shares are 30% undervalued, this stock is a dividend growth investor's dream. I hope you enjoyed today's video. Give us a like if you did. Please subscribe to the channel so that you're notified when new videos come out. And make sure to check the description box below for some informative links relating to today's video. I'll see you guys next time.